For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
That we are, Managing Your Financial Future. Johnny Dean, your podcast host, along with my good friend, Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. We talk about managing your financial future. And by the way, not just your financial future, but in some ways, the people who are going to come after you, or at least the people who are going to survive you.
I don't like the term, they're coming after me. No, I don't want them coming after me. I'm talking about the people I leave my money to, who get the money after me.
Exactly. And that's what we're going to be talking about today. We talked, it was last week actually, about 4 things every surviving spouse should know. And this kind of led into it was a natural lead into the topic today, which has to do with not just spouses, but its entire families. These are strategies to kind of protect your family's wealth. And this is something I don't think we spend a lot of time on in retirement conversations, but it does matter just as much as how you invest or how you take income. I mean, how do you protect your family's wealth when you're no longer here to protect it yourself? And Rick, a lot of people hear the phrase estate planning and they think it's only for rich people or only for people with estate tax issues, but that's not true. If you own a home, you have retirement accounts, if you have life insurance or anything that you care about going to the right people in the right way, this matters, and I know you've seen that firsthand.
Well, it happens. I mean, and I've had clients. It's interesting when you get into family dynamics, and you start talking about, well, you have plenty of money for your lifetime. What do you want the remainder to do when you're no longer here? Mm-hmm. And anything from, well, I want it all to obviously to go to my kids. Just split it 3 ways. They don't think about the fact that they have kids of different income levels, and they give everybody the same, a third of the Roth, a third of the personal account, a third of the real estate, and a third of the IRA, where you may be able to get away with doing some other things. Or they're giving money to charity, but they give the personal money to charity and the IRAs to the kids. Yeah. But it's also, I've had people tell me, I want my son and or daughter to get their share, whether it's half or all of the estate. But I do not want their money-grubbing, whatever you want to call it, spouse to be able to have any influence or any way of getting the money to them. And it's like, okay, that's going to be a little different game.
That's I think a somewhat common. I mean, not common, but it's not rare where that.
It's not rare.
happens.
And the other one is, I really want each of the kids to get their share, but my youngest, my middle child, whatever the case may be, they cannot handle it.
Yeah.
They will. Either they'll blow it, or God forbid, they'll kill themselves if they had the money because of their habits, their addictions, whatever the case may be. How do we set it up so that they get? I mean, we want them. We don't want to. We love them. We're trying to help them and do things, but we know that if they got $100,000, $50,000, $1 million, whatever the number is, it would be gone in a week, and they may not live, and it would be detrimental.
Yeah, and this is why we talk about things like this, because here's the reality of it is that during your lifetime, you can sign documents, you can move money, move property, fix whatever problems, but see, after you're gone, oddly enough, you can't sign anything. So that's actually a rule. If you haven't set things up properly, the state that you live in has already written a set of rules for you, and there will be a plan. The only question is whether it's your plan or it's your particular state's plan. So, and by the way, and we'll cover these. And the things that you talked about. Even if you do have documents, there are places where people get tripped up all the time. They think, for example, their will controls everything, but it doesn't. They think the trust automatically covers everything, but it might not. They assume their accounts will go where they want them to go.
And it may not be coordinated with the wishes that they have now. Well, I ran into this week, and this, strangely enough. Somebody came in and said, so-and-so passed away, I am the trustee of the trust. I am not a beneficiary of the trust. But I did get the specific bank account and the house. And they said everything was in the trust. I said, well, was the house in the trust? Was the bank account in the trust? Yeah. Then how did you get it? Well, they told me I was going to get it. And so and I was like, well, if it's in the trust, the trust now controls who gets what. And so you're the trustee. You can sign things on behalf of the decedent and things like that. But if the other beneficiaries find out, they can sue you and win because you're basically stealing from them.
Yeah, and they probably will win. So we're going to talk about these things, a few different things, and I should throw this in as well, Rick. I'm not a lawyer. You're certainly not a lawyer.
I'm not a lawyer, no.
No, we're not lawyers. This is not legal advice. It's more like education, and the goal is to help you understand kind of the big picture, what the documents do, how assets actually transfer, why beneficiaries matter, and all that kind of stuff. So let's get with the first step that you can do to protect your family's wealth, potentially anyway, which is to set up your documents. You just mentioned this, a will and a living trust. Can you just briefly talk about what a will and a trust actually do and why it matters?
Well, a will is the simplest estate planning document, and it gives direction to the state on who you want to receive your assets. So I write in a will that I want my estate to be split between my X number of kids, and I don't put any real other things. Maybe so-and-so gets the fine china, but nobody wants fine china anymore. So-and-so gets the silver, which may actually be worth something now. But other than that, anything left is silver. That is a direction to the court. It's still going to go through probate. What is probate? Probate is the court's process of changing an ownership on something to the next rightful owner. I mean, if I have a car and I want to sell it, I sell it and I sign the pink slip and transfer ownership with my signature. But what if I own a car and I die? And how does that car get transferred over to somebody else? The executor of the trust doesn't have legal authority to sign anything on my behalf. So we have to get the state's permission to sign it over to who the state says, after reading my hopeful directions from the will, to change it over to that person. Same thing with a bank account, brokerage account. Things that have a beneficiary, an IRA, a transfer on death designation. Those do not go through the will. So there's different levels of transferring assets, but the will says anything that I have not put a beneficiary on that I own, I would like to see it go this way. Now that the executor takes it to the court, gets their permission, and changes ownership. Probate costs money because you're talking about the state and the courts. It's different in every state. Some states are very simple probates. Some states are statutory fee. Some states are expensive and problematic. And a very simple estate shouldn't take very much to get the money to the appropriate people. Where you run into problems from time to time is if you have successive marriages, kids from different marriages, things of that nature, where somebody's getting disinherited or getting more than the other kids think they should get, or whatever the case may be, and there becomes problems with the heirs and they start contesting everything, then it becomes a problem in probate. But not every asset has beneficiaries or are easy to put beneficiaries on, and that's where the living trust comes in. A living trust is an ownership entity, quasi-ownership entity, that you transfer title to. So I transfer the title to my house to this living trust. Living means I can change it. It's a living, breathing document. It's not set in stone yet. And so it's totally changeable while I'm, the grantor, still alive. And so right now I want it to go evenly between my three kids, whatever the case may be. But maybe that changes in the future. And all these things. But once you put the money into the living trust, now there is a trustee. Generally, you, the grantor, are the trustee while you're still alive, still competent to handle things. But once you're either incompetent or you're dead, there is a named successor trustee who has legal authority to act on your behalf and write and sign things for you. So they get to change ownership. You don't have to go to probate. You don't have to do all that kind of stuff. The trustee gets to do all the paperwork to move things to the appropriate individuals. So the trust is a great way to avoid probate for many assets. What the trust can also do is provide control. With a will, stepping back to a will, if I say I want it to go to John Dean and Dave Smith and other people, it goes to them. Right? As soon as they can do all the paperwork, jump through the hoops, they get the money and there's no control put on them. If I want to put control and say, I don't want to get it until he's more financially responsible. He's only 61. He's just a young whippersnapper. He doesn't know how to handle money yet. I'm going to wait till he's 80 before he can get this money. I need I need a trust to be able to do that. And so either my will sets up a trust, which means it still goes through probate to get into the trust, or I use my living trust that then sets it up and says, control it for the kids, control it for this person. So there's control.
It's control, and this is one of the other steps that doing this allows you to do. Having the will and having the living trust, but the living trust with using
while you're living, and when you're no longer living, it is no longer a changeable document. It's a living trust while me, the grantor, is alive. But when I die, the next trustee cannot change anything.
Yeah, I guess it becomes irrevocable.
It becomes irrevocable at that point. You get a new tax ID number for it, away from the me. Because during my lifetime, it's just me as the tax ID number.
So when you have a trustee of a trust, they cannot go against the wishes of that trust, or at least they're not supposed to. I mean,
there's no trust police looking over their shoulder. The trust police are the beneficiaries saying, "Are you allowed to take that money and put it in your own bank account? Show me in the trust where it says you can do that." And they want an accounting of it. And so when you're a trustee, if you're the only beneficiary, you're the trustee and the beneficiary, you don't have to keep that many records of what's going on other than for legal purposes, because you're the beneficiary. You know what you're spending the money on. But if you're the trustee and there's multiple beneficiaries other than you want to keep track of everything, so that when those beneficiaries have questions, like what was mom and dad, or what was dad's estate worth, and why did I only get $20,000, or whatever the number, you want to be able to articulate that so that they don't sue you, and if they do sue you, you don't lose. So because that's the overall controlling issue, is somebody suing somebody. But the trustee is supposed to follow the trust's directions. And that's what the trustee's job is. It's to accumulate, records on everything, get a list of everything, pay off final expenses, and then once all the final expenses are paid, distribute it to or according to the trust document. But this is where you can add that layer of control for the kid, for the beneficiary who may not be able to handle it. Maybe, your kids are minors. Maybe you're doing this at a younger age. And while you may not have very much in the way of assets, I'm assuming you might have some life insurance. Maybe you have $1 million or $2 million worth of life insurance that you don't want a 14-year-old getting $1 million in cash or having somebody in charge of it. So that's where you put the trust as the beneficiary, and now the trustee is in control of that cash, spending it. Hopefully they're a much more mature individual handling it for the betterment of and the best interest of that beneficiary who is too young legally to handle it, and even maybe after they're 18, 19, 20, still controlling it so that they don't just blow it before they're 22.
Yeah, which can happen, and this shows the importance of having a person you can trust as the trustee.
Naming the trustee, the successor trustee, is tough. I mean, in our family, and my brother knows this, we did not name my brother. If my wife and I weren't here, we didn't name my brother as trustee because my youngest daughter had him wrapped around her finger. He would have done whatever she said, regardless of what age she was. Right. So he was never going to stand up to any of them. So it was like, no, we got to get somebody else that can say
right.
no.
Now, which could be okay, except there may be other beneficiaries who say, hold on, this wasn't supposed to happen, and they can sue you, and they'll probably win if it doesn't go according to what the trust
So depending upon the family dynamic, naming a successor trustee it's imperative that you do it right, and it can be tough because you don't want to pay a corporate trustee for most people. Most people don't want to, but they want to. But not everybody has the financial acumen to be able to do, and the accounting skills to be able to be the trustee.
Well, and this is why you take care of this stuff before you're gone, and why we're talking about it on this episode today. So setting up the documents, of course, that's important, the will and the trust. Those are things that you need to have. And then that led into the second thing that you just brought up, Rick, which is using the trust for control. In blended families, you got some vulnerable heirs, and make sure you have the right trustee. These are the kinds of things that need to be set up ahead of time to help protect your wealth. Now, you mentioned something about beneficiaries a little bit ago, and coordinating and review beneficiary designations will be another thing that you need to do to protect yourself, because, beneficiary designations transfer by beneficiary, and no matter what the will or trust says, they're going to go by that first, right?
Oh, yeah. That's the beneficiary is the first order of action. It goes to the named beneficiary. And so you want that coordinated with the rest of your estate, because, and unfortunately, sometimes people just want to do it as simple as possible. And maybe they've got a couple of kids. One of them is financially successful. The other one or two, maybe not quite as financially savvy. And so, and I've seen this with decent size accounts, not the big accounts, but they name one child as the beneficiary of their IRA. Mm-hmm. And they say, well, they'll take care of their siblings. They'll, okay, John, or I'm leaving you as a beneficiary, but make sure your sister and brother get their third, and you keep a third. Mm. Well, that makes it very difficult, especially if that one person you name is the more financially successful, savvy, sophisticated beneficiary. They may be in a higher tax bracket. So they inherit $300,000. $100 is supposed to be theirs. $100 is their brothers. $100 is their sisters. But and the brother and sister know this. They've seen the statement. They know that they're getting $100,000, and they want it right now. But the savvy, sophisticated trustee says, we don't want to take it out right now. That $300,000, because of what I make, we're going to pay $100,000, and I live in California. We're going to pay $100,000 in income taxes, and so you're only going to get $66,000. Yeah. Well, no, I get $100,000. Give me $100,000. Now I'll pay the taxes on it. You can't do it that way. And so so when you're naming the beneficiary, yes, it might be easier just to name one person and say, they'll take care of it. But first off, that person doesn't have to take care of it. What if that one financially savvy person is financially savvy because they're a snake in the grass, and they say, oh, yeah, mom, dad, no problem. I'll take care of the brother, sister, whatever. And as soon as mom and dad are gone, they liked me best. They named me beneficiary. You get nothing, and you'll like it, so go away.
But the whole point of that what you were saying is that understanding what's going to happen when beneficiaries receive certain things.
Oh, yeah.
Whether it's
very important. We had a client that has a very nice estate. They do not have kids. They have a good-sized IRA. They have a good-sized Roth IRA. They have a good-sized personal-sized asset with real estate and investments and things of that nature. And they're because they don't have kids, they're going to give money to their nieces and nephews and things, but not their entire estate. They're giving a decent amount of their estate to charity. But in their estate planning process, their estate plan was giving the proceeds from the real estate, or the real estate and some of the stocks, bonds, brokerage accounts, to the charities, and they named the kids, the nieces and nephews, as the beneficiaries of the IRAs. Yeah. Like, no. No. I mean, let's make sure that the values wrap up the right numbers, but let's give the IRAs to the charity, and then the brokerage accounts to the kids, because the brokerage accounts going to the kids don't include any income taxes at that point, and we're under the estate tax limit, and the money going to the charity isn't going to be taxable, even if it comes in the form of an IRA. If the kids inherit an IRA, they're going to have to pay taxes on that IRA. So who do you want to get the money? Do you want the IRS to share in your estate when you die?
Yeah.
Like, not especially. Let's change it. That $1 million you were given to the charity, let's give it from the IRA.
You mentioned assets that have beneficiary designations.
Yes, sir.
Things like IRAs. Talk about what types of assets would have beneficiary designations that would overrule a trust.
well, pretty much anything now can have a form of a beneficiary designation. Typically, the most common ones are retirement accounts. They have beneficiaries. Insurance, whether it be life insurance or annuities, they have beneficiaries. But you can put a beneficiary on a bank account, a brokerage account. You can put, in all 50 states, have the ability to put basically a beneficiary deed on real estate. They might call it something slightly different in different states, but you can go through on a bank account or a brokerage account. You can put either a payable on death (POD) or a transfer on death (TOD) designation on the account, and that's adding a beneficiary to that account. It will go to that individual when you die. Your IRAs, your Roth IRA, 401k, they all have beneficiary designations, and life insurance has a beneficiary designation, and it's very important. This is one you know about too. Years ago, decades ago now, we had a good client, and he was married, and his wife wanted to do something. They had some kids in the house, but they were getting a little bit older. She went, basically, 800 by 800 term or 800 by term. She bought some insurance, and she shopped it around. She got, inexpensive coverage. She did it all herself. And then about 5 years later, unfortunately, she got cancer and she passed away. And it was like a $150,000 death benefit, which is nice. But when she did the paperwork, she never filled out the beneficiary designation. She didn't name her kids. She didn't name her surviving spouse. It was completely blank. And so now this went into her estate. So now her estate has to be settled. And it is no longer at this time, it was no longer a small estate, because at that time the small estate was $100,000 and this was $150,000. So they had to open a probate and work through the probate process to get the money to the surviving spouse. What should have taken a couple of weeks from the time they got the death certificate and turned it over to the life insurance company, and then they would have just written a check to the beneficiary, took something like a year and $10,000 of BS paperwork to get that $150,000 death benefit to the appropriate heir. Why? Because you forgot to put a name. Something as simple as that. Reviewing your beneficiaries on your accounts, reviewing the ownership, where it's going, doesn't take very long. And it's one of those things that you should do all the time. We do it when we do reviews with people. We say, okay, now the beneficiaries of this account are X, Y, and Z. And normally the people are like, yep, that's good, that's good. And then sometimes they'll say, oh, wait a minute. No, that has changed for whatever reason. So-and-so passed away. They're no longer a beneficiary. Or that person has, they won the lottery. They don't need the money. Or whatever. They ticked me off. They don't get the money. Whatever. So, but just going through it, you don't remember these things, but you want to look at them periodically and just update it to make sure it's all coordinated with what A, your wishes are, and B, how your estate is set up.
Yeah, I know you've seen, and I've heard of people who have gone 10, 15 years and just kind of forgot about what was in the trust or what was set up, and they have, they set things up when their middle child was still married to somebody else, and now they have another spouse that isn't liked. I mean, these are things that need to be reviewed. How often do you need to review these things? I mean, it doesn't have to be once a year, does it? I guess it could be.
No, we just bring it up once a year, once when we review the client with the clients. And like I said, typically it's, yeah, everything's fine. But anytime there's some kind of life-changing event, your kids get married, your kids get divorced, your beneficiary, passes away or whatever, when things change in your life, is when you review what you want to change after your life. And so there's no bad time to do it. It's not difficult. Now, some people have accounts everywhere. And so in some respects, simplifying your life makes it easy too. And people are like, well, I don't want to have all my assets in one company. It's like, okay, you have them all in Schwab. You have them all at Fidelity. You have it in Vanguard. And you have mutual funds. If you moved them all into one place, you're still not having it all in one. You have it in one account area, but you still own 55 different stocks. It's not putting all your eggs in one basket. They're just being held in one place that can hold them for you and make your life a lot easier.
Well, and last thing on this, now we've talked about the things you can do to help protect your wealth would be to set up your documents, your will, and your trust. Make sure if you need to use the trust for control in blended families or whatever it is, you can do that, but review your trust for that. We talked about coordinating beneficiaries and making sure that it's going to the person that you want them to go to, because they do override everything else. And then you kind of alluded to this just very quickly because we don't have a lot of time left, but when we talk about matching the accounts to the different people who are getting the money, just mainly for tax efficiency, I think this is where it's really helpful to have an advisor help you out and go over these things so that they can tell you, well, here's the impact that you leaving this particular asset or account is going to have.
Oh, right. I mean, obviously, if I am a beneficiary, I want the Roth IRA if I have my choice, because then I don't have to pay taxes. But that's not always but if you've got different types of accounts, personal accounts, not tax deferred, traditional IRA, traditional tax deferred retirement accounts, and the third type is Roth accounts. Going back to that example where one of my children, if this were the case, was financially well-to-do and the other two weren't as well-to-do, it may be better for me to leave the Roth IRA to the financially well-to-do one, and maybe the traditional IRAs, even if it's a little bit more, to the lower income beneficiaries, because they'll pay a little bit of tax, but they don't pay anywhere near as much tax as the other one. Now, a lot of people just say, they're getting free money, split it 3 ways, everything. I don't want to deal with it. But that's okay too. That's your call. But if you want to see and be as efficient as possible to the heirs, let's take a look. Like I was talking about with that person that's giving money to charity. If you're giving money to charity out of your overall, assets, give them the IRA. Mm-hmm. Because, don't give the kids the IRA and the charity the personal money. Give the personal money to the kids because they get a step up in tax basis. They don't have to pay taxes on it. They get to receive that money basically tax-free. And the charity still gets the money tax-free because they don't pay taxes.
We've talked about, somebody's going to pay taxes on your IRA, on your 401k or your pre-tax account.
Unless you leave it to a charity.
Unless it goes to a charity, then I can't think of a situation where a legitimate charity is going to have to pay taxes on it. So that's a big one. We've mentioned this a few different times on a few different episodes, but that's something to consider. So the tax efficiency of it, if you care, and you just said, Rick, maybe you don't care.
And if you don't care, that's fine. It's your money.
Yeah, it's your money, and hey, you're right. Hey, are you going to complain that you're getting $300,000 or whatever the number is? So you got to pay a little taxes on it. But there are family dynamics involved here.
I have seen people that say, you know what, I'm not going to do a trust. I don't even care if I do a will. I'm not here anymore. I do not care. Mm-hmm. And if you're close to a person like that, you may want to say, okay, I'll help you do this so that it saves my life, aggravation. You may not care, but it's going to create a ton of work for us. Yeah. And maybe you don't care, but do you mind helping us a little bit now? Or sometimes they'll say, what do I care about that? I didn't care about it. But every once in a while, and this is rare, but every once in a while I've run into somebody who, whatever, let them fight over it. I don't care. Well, then the other one is, there won't be anything left. I want the last check. This is back when people wrote checks. I want the last check that my estate writes to bounce.
Which is always great because usually it's the undertaker or whatever, the funeral home.
I'll tell them we can develop a plan that will work if you give me one important detail.
Mm-hmm.
When's that check going to be written? What day?
What's the date? Because we will back time this.
We'll figure out how to spend every dime you have, but you're going to have to die on schedule.
Yeah.
That's horrible.
Which generally isn't going to happen. That goes back to the old Sicilian
I hope you don't know when you're going to die.
Yeah. No, I would think not. I said that was going back to the old Sicilian actuary joke, which I'm not going to tell here, but it's one we did on all of our seminars. So again, just to wrap this up, you want to help protect some of your family's wealth, the wealth that you've accumulated. Things can happen. You want to set up your documents. You want to coordinate your beneficiaries. You want to make sure that you can, if the trust is there for control, make sure that you have the kind of control that you want. You want to match your accounts to the correct people, if that's what you care about for tax efficiency. And like Rick just said, it's imperative, if you care, where the money goes after you're gone. If you don't care, hey, you can't take it with you. You're probably not going to need it. So, you can let it go. But I think most people do. Most people do care what happens. So, and as you can see from this, protecting your family's wealth has less to do with how much you've accumulated necessarily, and I think it has more to do with how it's structured, how it transfers, and whether all the moving parts actually work together the way you intend them to. And if you'd like to talk through your own situation, you can certainly reach out to the advisors at Lucia Capital Group, 800-644-1150. 800-644-1150, the phone number there at Lucia Capital Group. Professor Rick Plum heads up the financial planning department, and as I tell you a lot, these are exactly the kinds of coordination conversations that they have with their clients every day. Make sure the estate plan, the beneficiaries, tax strategy all line up. And of course, all the bucket strategy and wealth planning pieces that go along with it, too. They take care of that stuff. Don't forget to visit luciacap.com, LUCIACAP.com. And while you're there, I should mention this, and I should have said this at the top, make sure you download our estate planning guide, which kind of is what we were talking about today. It walks through everything that we talked about today in more detail. You can download it for free at luciacap.com. Wills, trust, beneficiaries, probate, tax considerations, all that stuff is in one place. Just go to the search bar in the upper right corner, type in estate planning or estate planning guide, and you can download it for free. It's really, really well done. And don't forget to subscribe to the podcast, Apple Podcasts or Spotify, so you don't miss an episode. Plenty more topics coming up that can help you manage your financial future, and that's why we're here. We are out of time. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny D. Thanks so much for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Other risks can include, but are not limited to, declines in the value of real estate, potential illiquidity, risk related to general and economic conditions, stage of development, and defaults by borrowers. Stock investing includes risks including fluctuating prices and loss of principal. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties and, if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. Any other company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial. LPL Financial Insurance License number 0518721. LPLIA Insurance License number 0B91442.